Hello everyone, a very good evening. Welcome to this demo session of the CAIIB Crash Course for your November-December 2025 exam cycle. In today's session, we are going to discuss first the basics about our BRBL paper, what will be our strategy in our crash course, and then we'll start with our unit 1 from our syllabus. All right, so stay till the end. We'll be starting with the syllabus with the first unit. I'll also be discussing the basics, like what should be our strategy for the remaining days that we have in our hands. All right, so once you're here, please mark your presence so that I can know everyone who has joined the session. Those who have joined from YouTube, you have the live chat. You can comment in the comment section if you don't understand anything. Good evening. Good evening. So let us start. All right. First, the basics about our BRBL syllabus, our BRBL paper. We have four modules that we need to cover. Module A, which has 7 units, is completely theoretical. The regulations and compliance, you have to study basically two acts here, RBI Act and the Banking Regulation Act, right? These two acts you need to study. The constitution of banks, the regulation of banking business. I am great. Thank you. And other than that, winding up mergers, NBFCs, these topics are there. Basically, two acts. Then module B, it has 6 units. Laws relating to the banking operations. FEMA Act, PMLA, mortgages, the different types of charges that are created. Module C and Module D. Module C and Module D are very important. Module C again has acts like the you'll be studying about the MSME Act, what is the role of the banks there. You'll be studying about SURFACI Act, IBC Code, the Legal Services Authorities Act. These are there. And then Module D, which has commercial laws. Companies Act, LLP Act, meaning of a contract, sale of goods act. Talking about the weightage, as I've already and every time told you, highest weightage is of Module C and Module D. Together, we can say 65 to 70% of the paper comes from Module C and Module D. Remaining 30-35% is from Module A and Module B, right? So we can say that 30 to 35 marks each from Module C and D. Then from Module B, you'll have around, let's say, 20 to 25 mark questions, and Module A has the least weightage, 5 to 10 mark, right? This is how the modules have weightage in our exam. Each of the modules, the acts that you need to study, like I said, in Module A, the Banking Regulation Act and the RBI Act, legal framework of regulation of banks, control over organization of banks, regulation of banking business, the returns, inspection, winding up schemes, how they are prepared, the constitution of the different types of banks in India, NBFCs, and the recommendations made by the Narasimham Committee 1, Narasimham Committee 2 for the financial sector legislative reforms. Then Module B, you need to study the Prevention of Money Laundering Act. What is the role of banks? How do they reduce the chances of money laundering, right? um, the records that have to be maintained, the information to be maintained in the record, Negotiable Instruments Act, where the check dishonor part is covered, protection given to the paying or the collecting bank, Foreign Exchange Management Act, role of the authorized dealers, Payment and Settlement Systems Act, whenever a payment settlement system is set up, authorization from RBI, rejection of authorization, and so on. Mortgages, other types of charges, assignment, set off, lien, and creation, registration, satisfaction of charges. Right? These are the units in your module B. Module C, maximum weightage, Ombudsman Scheme, MSMED Act, SURFACE Act, Recovery of Debts, RDB Act, IBC, Bankers Books Evidence Act, LSA, Consumer Protection, Law of Limitation, and Tax Laws. Out of these, maximum questions they come from the SURFACE Act, IBC, RDB, and the Legal Services Authorities Act. Right? Weightage of the Bankers Books Evidence Act or tax laws is the least. Then Module D has the commercial laws. You'll be studying about the Indian Contracts Act, the different types of contracts, guarantee, bailment, pledge, right? Then Sales of Goods Act, what are the rights of the unpaid seller, duties of the buyer and the seller. Indian Partnership Act, liability on all the partners, Companies Act, MOA, AOA, the registered office, registered name clause, all of these things. Limited Liability Partnership Act, how the LLPs are formed. In the Transfer of Property Act, you will again be studying about the different types of mortgages, which is very, very important. Right to Information Act, Right to Information and their obligations, Information Technology Act, and the Prevention of Corruption Act. These 10 acts you need to study in your Module D. Out of these, the most important are the Companies Act, LLP Act, the Indian Contract Act, Partnership Act, and the Sales of Goods Act. RTI, IT, and Prevention of Corruption Act, these are not that important. Right. Now, why have we given this name Crash Course to our batch? This new batch that is starting from today itself, because today is 12th of September. Your exams are starting from the end of November. So you have time of September, October, and November. In the last week of November, you will be preparing for your first paper. In this exam cycle, there's no gap for your BRBL paper. Usually we get 1 week, so we do not have 1 week there. Crash course is for your revision, right? So if and once you have completed your whole syllabus, you have a strong foundation, then this crash course will be for your revision. We'll be revising the whole syllabus. All the units will be covered, but in a fast manner, in a concise manner, right? We'll be focusing on the exam specific content. Exam focused notes will be there. Only those things that have been asked in the previous exams and those which are the most expected in the coming exam cycle, right? So the complete revision strategy is your crash batch, right? And now, like I told you in the beginning, we are going to start with the first unit of your module A, which is the regulation and compliance, legal framework of regulation of banks. In this unit, basically, you have to study about the meaning of banking, the constitution of banks, under which act the banks are established, how they get their registration, the provisions of RBI Act, Banking Regulation Act, control over the regulation of banks, also what powers have been given to the central government. These are the things which are covered in your first unit. Again, one another important point, from your module A, which is completely theoretical, you will mostly get questions from sections. There are various sections that you need to remember from your Banking Regulation Act and RBI Act. First, most important section is the section 5B of your Banking Regulation Act of 1949. It gives the definition of banking. What is banking? Accepting the demand deposits for the purpose of lending or investing, right? So there are banks. Only banks are allowed to accept deposits which are withdrawable on demand by check, draft, any other manner, right? These deposits should be used by the bank to give out loans or invest in securities, right? So that is the meaning of banking. Acceptance of deposits from the public, using these deposits for lending or investment, right? Now, when the banks are accepting these deposits, there are regulation of banks. In the demand deposits, interest has to be paid on the saving side, right? Although the interest is not fixed, but it is regulated by RBI. Then on the loans as well, when the banks are giving out loans, again interest is not fixed, but it is regulated by RBI. It has to be based on certain benchmark, right? External benchmark, MCLR, BPLR, that we are going to study, right? So first important section that you need to remember is section 5B. So these deposits are repayable on demand, or they can be repayable after a period of time, right? Either demand deposits, CASA, or are fixed deposit as per the agreement between the banker and the customer. Also, deposits of money only. Banks are not allowed to deal in any goods. They will accept deposits of money. They will give out loans of money only, right? Also, when they're accepting deposits from the public, it is important that the banks, they consider the KYC norms, they carry out due diligence, and they accept deposits only from the respectable customers. Wherever there are chances of money laundering, corruption, terror financing, anything like this, banks can also reject to open. So proper identification, once it is done, only then the bank will open the account for the customer, right? Customer identification, protect the banks from frauds, monitoring of transactions of a suspicious nature, combating financing of terrorism, these things should be done, right? Another important section, section 49A of the Banking Regulation Act. No person other than a banking company, RBI or SBI, or any other institution notified by central government is authorized to accept deposits withdrawable by check. So the deposits which are demand deposits will be accepted only by the banks. This is given in section 49A. What is the meaning of this? When we are talking about acceptance of deposits by the non-banking entities, the NBFCs, right? They will accept deposits from the public, but they cannot be demand deposit, right? So they can accept fixed deposit, they can accept deposit on under any scheme as formulated by the government, right? So there's a direction, the NBFC's acceptance of public deposits directions given by RBI in the year 1998, right? 1998. This is covered in another topic, the regulator of NBFCs, what role does RBI play? All right, so under section 49A, only the banking company, RBI, SBI are allowed to accept deposits which are withdrawable by check, right? Then we already know about the section 22 of our Banking Regulation Act, that for commencing or carrying on the business of banking, if any entity wants to start the bank, they want to accept demand deposits from the public, they want to give out loans to the public, they first need to get a license for banking from RBI. This is the section 22 of our Banking Regulation Act, and they have to use the term bank as a part of its name. No other individual company they can use the term bank. So this acceptance of deposit, giving out of loans, comes under the permitted business of bank, right? Permitted business of bank. Other than that, they're also allowed to deal in the bills of exchange, drawing, accepting, buying, selling. right? They can transact every kind of guarantee and indemnity. But what is important is that we remember the prohibited business. Here comes the third important section. Section 8 of the Banking Regulation Act that prohibits a banking company from engaging directly or indirectly in trading activities or undertaking trading risk. Directly means the banks cannot deal, buy, sell, or hold in favor of their customer any tangible goods, right? Neither can they through their subsidiaries or through their holding company, they're allowed to engage in trading business. This is prohibited. So buying or selling or bartering of goods is directly, indirectly prohibited. Bartering means exchange of goods. Commodity exchange, not allowed. So goods means every kind of movable property, any movable property. It can be any asset, it can be cereals, it can be anything other than actionable claims, stocks, shares, money, bullion, and specie. This question was asked by the institute in the previous exam, right? What comes under the or what is allowed under the permitted business, right? So the banks are allowed to deal in the movable property only if it is actionable claim, stock, share, money, bullion, or specie. Other than that, dealing in any kind of movable property, not allowed. If due to any reason, any movable property or any immovable property other than security comes to the banking company, they have to dispose it off within a period not exceeding 7 years. This is an additional information, although not important. All right, so important sections till now that we have discussed: Section 5B of the Banking Regulation Act, then the Section 49A of the Banking Regulation Act, Section 22, and Section 8. All right. Like this, you need to study your module A. You will have to remember these important sections and only these important sections. There are many other sections that are discussed in your unit, like section 6 is discussed, section 3 is discussed, not important. All right. Next, a second, I think there's some technical issue. Hmm. So it can also be a foreign company which is registered under the Companies Act of that particular country, right? So also the third part, it can be a cooperative society registered under the central or the state enactment. There's the State Cooperative Societies Act. If the cooperative society is operating within one state, there's the Central or Multi-State Cooperative Societies Act. If the cooperative society is functional in more than one states, right? Good evening, Irfan. I'm great. How are you? Right. So accordingly, we will have the public sector banks. Other than SBI, the public sector banks will be established under a particular statute. We are not talking about the license. License they get under the Banking Regulation Act. We are talking about their incorporation, right? So the public sector banks are constituted under the Banking Companies Acquisition, Transfer of Undertakings Act of 1970 and the Banking Companies Acquisition and Transfer of Undertakings Act 1980. These two acts specify what should be the capital requirement, what should be the nature of the directors or the people who are setting up, right? What will be the source of their funds? These things are defined under these two acts. This topic, the constitution of banks, is covered in detail in our unit 5, right? Second category of banks in India, or the single bank, SBI, the largest public sector bank. It is also constituted under a particular special statute. That is the State Bank of India Act of 1955. Again, in detail, we'll be studying it in the Unit 5. So there was earlier the presidential banks in India during the British time, right? They were integrated into one. Imperial Bank was formed. Later on, there were the seven subsidiaries of SBI that were integrated over a period of time. All of these things are there in your Unit 5 that you will be studying. All right, so SBI is constituted under the SBI Act of 1955. The seven subsidiary banks were constituted under the Subsidiary Acts, and over time they have been merged. This process of merger is completed in the financial year 2017-18. Third category of banks are the RRBs. RRBs are established by the central government. These are a sort of differentiated banks. Their role is to function in one or more rural areas. The 35% of the issued capital of RRB is by the sponsor bank. 50% is by the central government. This is also there in our Unit 5. I will be studying it there. 35%, 50%, and the remaining by the state government, right? So RRBs under the RRB Act of 1976, they are established by the central government wherever required, and they also come under the Banking Regulation Act and the RBI Act provisions, right? This is to develop the rural economy, providing credit, microcredit for the development of agriculture, trade, commerce for the small and marginal farmers, the agricultural laborers, right? Then we have the private sector banks or the foreign banks. Private sector banks, they are established, they are incorporated under the Companies Act. Foreign banks are incorporated under the Companies Act of their government, of their country, right? There are many large private sector banks in India that are having business even more than public sector banks today, right? So, private sector banks, including the micro and small finance banks, are companies constituted under the Section 3 of the Companies Act 1956 or 2013. Foreign banks are basically foreign companies. They will have wholly owned subsidiaries in India. They can have branches in India. They are constituted, they are established as per the Companies Act of 2013, and there are certain requirements. When will a foreign bank be allowed to function in India? When the countries have a good relation, they fulfill the requirements, like when there's the capital reserve requirement for public sector banks, foreign banks have to maintain a part of their profit with RBI, right? So all of these things they will have to follow if they want to operate in India, right? Then cooperative banks are the cooperative societies who want to convert in a bank to provide the loans. So cooperative banks, they conduct the ordinary business, but they are established on a cooperative basis. The history of Indian cooperative banking dates back to the Cooperative Societies Act of 1904. The main objective is to encourage thrift, self-help, and cooperation among the agriculturalists, small farmers, and so on. All right. So cooperative banks is also a category of banks in India. Now cooperative banks also come under the regulation of RBI. Earlier they did not, and recent amendment was made. Now RBI controls the cooperative banks as well, right? The cooperative credit societies can be divided into UCBs, urban cooperatives, and rural cooperatives, scheduled and non-scheduled. Rural cooperatives are divided into the long term and short term, right? And the whole classification again we'll be studying in detail in our Unit 5. All right. There are also differentiated banks under which we have the payment banks, the local area banks that also operate in India, right? So these are the different categories of banks. Okay. Cooperative banks also have to follow the minimum paid up capital and reserve requirement. There are restrictions on loans and advances. They also require licensing from the RBI under Section 22 of the Banking Regulation Act. They need to maintain liquid asset account and auditing requirements. Inspection is conducted. All of these things are there. Okay. If the cooperative bank is operating in more than one state, the Central Act, multi-state cooperative societies apply. This means they will have to get themselves registered under the Central Act. Other cases, if the cooperative bank is operating in only one state, then the State Cooperative Societies Act would apply and the Banking Laws Application to Cooperative Societies Act. This amendment or this act was given. So now the provisions of Banking Regulation Act and RBI Act are also extended. If you remember, when in the year 1949, when the banking companies, the Banking Regulation Act was enacted, the original name was Banking Companies Act, not Banking Regulation Act. Why? Because the act originally covered only the banking companies. Then in the 1960s, amendment was made. The cooperative societies were brought under the regulation of RBI. The name was changed to the Banking Regulation Act. Some powers were given then. Remaining powers for regulation and monitoring have been given to RBI after the Banking Regulation Amendment Act for 2020. Right? So the cooperative banks, the RBI has more powers to better regulate these entities. They also play a very important role in the development of the backward areas, the weaker sections, the rural areas. Thus, it is brought under the purview of RBI. The regulation, licensing, requirements of auditing, everything. So these were the provisions of the Banking Regulation Act. Now we come to the RBI Act. Before we start with the RBI Act, till here, everything is clear? The important sections, the meaning, the types of banks, the three categories of banks, everything is clear? Give me a confirmation. Clear? Great. All right. Next, we have the RBI Act. RBI is the monetary authority, it's the central bank. RBI has been given the powers, it has been given the authority not only to regulate the banks, regulation of bank is limited. Basically, RBI has been given the power to monitor the bank. Regulation of banks come under the Banking Regulation Act. RBI Act is going to monitor the banks in terms of the paid up capital reserve requirement, in terms of the liquid assets, SLR, CRR that has to be maintained. RBI will monitor that the bank is not conducting any activity in detriment to the health of the financial sector or to the public, right? These things, these responsibilities have been given to RBI. RBI is also the monetary authority. This means to maintain financial stability in the country. Wherever there's a very high inflation in India, RBI will control the lending activities. RBI will increase the SLR, CRR requirement. Wherever there is deflation in the economy, what will happen then? RBI can reduce the reserve requirement that will increase the bank's lending capacity, give more purchasing power to the public, right? So RBI monitors the banking segment, it also monitors the financial health of the nation. So RBI Act of 1934 was enacted to constitute the Reserve Bank of India. It came into force from 6th March 1934. The RBI as a central bank was established in 1935. The primary aim to act as the central bank to regulate the issue of banknotes. RBI has the whole sole authority of issuing banknotes. No other authority is allowed to print currency notes. Why I'm saying currency notes, not the whole currency, because coins is kept with the central government, rupee one note is kept with the central government, right? So RBI has the whole sole authority to issue banknotes, keep a reserve with a view to secure monetary stability, operate the currency and the credit system. RBI acts as the banker to the banks, banker to the government. RBI acts as the advisor to the government. Wherever there are any international issues, export related issues, RBI will give instructions to the government to correct their action. Wherever RBI thinks that the bank is almost out of cash, they are going on the verge of liquidation, or they are giving easy loans, or they are giving loans only to the corporate segment. RBI can, through moral suasion, control their activities, right? So, all of these responsibilities have been given to RBI. RBI does not deal directly, the RBI Act does not deal directly with the regulation of the banking system except for the section 42. Like I told you, regulation of the banking system is under the Banking Regulation Act. RBI monitors the banks. Apart from section 42 of the RBI Act, which provides for the cash reserves of the scheduled banks to be kept with RBI. Banks are required to maintain the cash reserve ratio and the statutory liquidity ratio that is given in section 42. Other than that, RBI Act does not directly regulate the banking business, right? Okay. There's the Central Board of Directors. Every bank has this. It consists of the governor, not more than four deputy governors, directors nominated by the central government, like this. Okay. Then we have already seen how under section 22 of the Banking Regulation Act, RBI gives license to the bank. So a new bank is to be established. Before starting their operation, they have to apply with the RBI. If an already existing bank was there before 1934, within 6 months of 1934, before enactment, they have to apply for the license. RBI will check the fit and proper criteria, the nature of the directors, the banking business, the past history of the promoters, everything. And then RBI can give the license, they can reject the license. RBI has the right to cancel the license as well, right? RBI can remove the directors of the bank, RBI can change the management of the bank. Everything will be done by RBI. All right. So, establishment, incorporation, management, the business that RBI may transact, all of these things are given in the RBI Act. All right. What else? What else? RBI acts as a lender of last resort. I told you RBI acts as a banker to the bank. Let's say banks are on the verge of bankruptcy. They are almost moving towards liquidation. They have tried to raise funds through the market. They have issued shares in the market. Still, they are unable to recover. They can, as a last resort, take a loan from the RBI at the bank rate, repo rate. They can take a loan. So, RBI also acts as a lender of last resort for the banks and financial institution, right? RBI Act has been amended from time to time. We saw an amendment where the cooperative banks are under the monitoring of RBI now. There was also an amendment made in 2019. So the NBFCs are now under the regulation of RBI, right? Another amendment was made in which the section 45 MAA was introduced. RBI has been given the power to remove or debar an auditor from exercising duties as an auditor for an RBI regulated entity. This is also an important section. Then amendment was made for the providing resolution to NBFCs. RBI has the power to inspect the books of NBFCs in the public interest or financial stability. They can frame schemes to preserve the continuity of NBFCs. This topic in detail we'll be studying in our Unit 6, non-banking financial companies. All right. Then, other than this, a newly inserted section for NBFCs 45 MBA. RBI is given powers to frame schemes for amalgamation, reconstruction, splitting of an NBFC. NBFCs, if they are not viable in their business, if they are facing losses, RBI can frame scheme to shut them down. RBI can frame schemes to amalgamate two NBFCs, right, to smooth for the smooth functioning of the financial system. RBI can also direct an NBFC to furnish statements, information in order for inspection or audit. This is there under section 45 NAA. So you need to remember 45 MBA and 45 NAA. This is regarding the regulation of NBFCs. I will provide you the foundation course students, aspirants, you already have that PDF. I will provide you with the PDF of all the important sections across all the units of your syllabus. You need to remember only those sections. All right, nothing more than that. Banking Regulation Act, we have already seen. This point that I told you, the change in name of the Banking Regulation Act, it was passed as the Banking Companies Act of 1949. It was changed to the Banking Regulation Act 1949. The name was changed to the Banking Regulation Act when? From 1st March 1966, because it is applicable to the cooperative banks also. Initially, the Banking Companies Act was applicable to the banking companies alone. After the change in its name in 1966, it is applicable to the cooperative banks as well. So, all the provisions of the Banking Regulation Act, the inspection to be conducted, the audit to be prepared, the risk-based supervision to be done, everything will be applicable on the cooperative banks as well. Another important section, Section 35 of the Banking Regulation Act. RBI has the power to conduct annual financial inspection. Now, every category of bank has separate provisions. They need to maintain their annual financial statements. They need to furnish it. Some statements are to be furnished to RBI, to the central government, as well as SEBI, right? Like if we are talking about the um, management of affairs of RRBs, right? Or the management of affairs of the public sector banks, right? So they have to furnish reports to RBI. Similarly, private sector banks, different regulations are there that they have to follow. SBI, basically, it controls their own audit and inspection, but they also have to close their balance account and they have to send their reports to the central government as well as RBI. So, how is it done? Again, in Unit 5, we'll be discussing. All right. So under section 35, the accounts and audits will be prepared by the respective bank and it will be furnished to the RBI. Right. So you need to remember section 36. 5 as well. RBI makes a comprehensive risk assessment under the risk based supervision, right? This is known as SPARK, Supervisory Program on Assessment of Risk and Capital. Under this, RBI frames the rule how the risk supervision, monitoring, inspection has to be done. Then already you would be knowing about the DEAF, the Depositor Education and Awareness Funds. Basically, all the inoperative accounts, wherever there are fixed deposit and it remains unclaimed for more than 10 years, or accounts that have not been operated for more than 10 years, funds will be transferred to RBI. A separate fund will be maintained, the DEAF, and it will be used to generate or spread awareness to the customers, right? And it is to be done within a period of 3 months from the expiry of the said period of 10 years. Again, it is a detailed concept. Once the money has been kept in the fund, after that also, anytime the depositor can come to the bank, they can ask them to return the funds after giving reasonable ground why they could not collect it earlier. If it is a deceased depositor, then nominees can come, claim it after 10 years also. So the bank will have to return it to the customer, right? So the Banking Regulation Act provides the specific legislation to the business of banking, prevents the bank failures by prescribing the minimum capital requirements. It also ensures the balanced development growth of banking companies, gives specific powers to RBI, safeguards the interest of depositor, right? Then we have seen how RBI acts as the regulator of the banking business. Government, the central government has also been given some powers. Before we start with this topic, provisions of RBI Act clear? We have just discussed the basics of it. In detail, we'll be covering in the further units. Basic provisions of the RBI Act clear, everyone? Yes? Clear? Great. All right. What powers are given to the central government? I told you that RBI, okay, let us cover it later on. Basically, RBI and the government, they need to work in tandem. RBI can give advice to the government for the regulation of the financial stability. Government can also give some directions to RBI in consultation with the governor of RBI for the financial health of the nation, for better functioning of the banks, but only in exceptional situation, right? So RBI is the primary regulator of banks, but central government has also been given some powers to regulate the banks directly or indirectly. These powers are given under the RBI and the BR Act, right? Like there's the central board of RBI. The members and governor of the central board of RBI are appointed by the government. Officers are nominated by the government. Government is also the sole shareholder of RBI. Earlier, government had 51% shareholding. Later on, it was wholly acquired. The whole shareholder, the only shareholder of RBI is the government. So, the powers that have been given to the government are under Section 7, subsection 1 of RBI Act. Basically, the central government can give directions to RBI wherever considered important in public interest in consultation with the governor of RBI. So the central government will meet the governor of RBI. They will have discussions and then they will decide on what should be done for the improvement of financial health. Right? These powers are to be rarely used. only in exceptional cases, and till now the powers given to central government under Section 7 of the RBI Act have been utilized only once. When? Very important, you need to remember. First, you need to remember the Section 7(1) of the RBI Act, government as a regulator of banks. Then, when has the government used this power? In October 2018, where separate letters were sent to RBI governor giving directions on issues ranging from liquidity for the NBFCs, capital requirement for the weak banks, and lending to the small and medium enterprises. So, three things regarding the financial health of NBFCs, regarding the improvement and recovery of the weak banks, and lending to SMEs. So, 3 points are here, right? Section you need to remember, when the power was used and regarding what the directions were given. All right. Other than that, government also has powers. RBI has the power to remove any managerial person of a bank. Let's say there's a director of the bank who was found to be involved in insider trading, or they were found to be involved in corruption or doing anything. Let's say the bank director, they permitted a loan to one of their family members. RBI can remove the managerial person of the bank, but this managerial person will be given a chance to be heard. They can make an appeal to the central government. So central government will hear the appeal against the removal of a managerial person of the bank. You need not remember the section, just remember that central government will hear this appeal. RBI can also cancel the license of a banking company. Let's say the banking company has, again, they have given loan to their own directors or to the shareholders, or they have committed any criminal offense, involved in any activity detrimental to the public or to the depositors. RBI will cancel their license. They can make an appeal to the central government. RBI can also refuse the certificate, refusal of certificate regarding floating charge on assets. In the module B, we have studied about the fixed and the floating charge. If a bank wants to create a floating charge, RBI has refused their certificate. They can also make an appeal to the central government. Central government can also, under specific directions, exempt a particular bank from the provisions of the Banking Regulation Act. Let's say there's a small finance bank established. The Banking Regulation Act has provisions for the minimum capital requirement. If the central government thinks it is necessary in the public interest, they can give exemption to the banking company from this provision, right? Other powers given to Government of India: approval for formation of a subsidiary by the banking company, notification with reference to accounts and balance sheet, direction for inspection. When audit is conducted, normally it is conducted on the direction of RBI. Special audit will be conducted by RBI on direction of the government. Inspection can be also conducted by RBI on direction of the government. There, the report also has to be sent to the government. Very detailed topic, we'll be covering it in the unit 4. Right? Appointment of a court liquidator. Let's say the bank has to be liquidated, or the CIRP has to be initiated. There also the central government plays its role. Central government will frame the scheme for amalgamation, mergers, winding up. Central government has the powers to disinvest in a particular bank. All of these powers have been given to central government to regulate the banks. In addition, the government also is a majority shareholder or a full owner of the public sector banks which are under the statutes constituting them. All right. So the central government also has been given some powers to regulate the banks. Other authorities also have some powers apart from the activities, the usual activities, accepting deposits, giving out loans. On the liability side, on the asset side, banks are also involved in para banking activities where they provide other party products or third party products. Banks can act as an agent of an insurance company, sell the insurance product to the depositors, to the borrowers, to the customers. Banks can also act as brokers for the mutual fund product. Banks provide portfolio management services, tax planning, wealth management. So, wherever these activities are conducted by the banks, they are also regulated by the apex regulator. Like mutual fund is there, if insurance business is there, IRDAI will have the regulation. If pension fund business is there, PFRDA will have. If they're dealing in foreign exchange, Exim Bank, right? So, a banking company will be subject to the control of the authorities under the Companies Act. Bank is also answerable to the labor authorities in terms of the service of the workmen. Banks are also liable to pay income tax, other cash transactions, GST. Also, they're required to follow the TDS and transfer it to the government. Then, for instance, the case of dealing in securities, they're subject to the regulation by SEBI under the Securities Contract Act. They will be regulated by the provisions set out by SEBI. If the bank is conducting the insurance business, they have to follow the IRDAI regulations. In case of mutual fund, merchant banking, again, they have to follow the SBI regulation, sorry, SEBI regulations, right? So, whatever business they are conducting, other than the normal banking business, the apex authority conducting or regulating the whole business in the country will have its regulation over the banks as well. All right. And that is all. Done. The unit 1 of your module A is complete. This was just an introductory unit, right? All of these provisions, the titles that are given, will be discussed in detail in the remaining 6 units of your module A. All right, so like this, if we took all the theoretical aspect, it would have taken us at least 2 hours to complete the unit 1. But we have focused only on the exam specific content. Nothing out of this, nothing other than what is given in the PDF will be asked from the unit 1 in your exam. All right, so that is all for today. I hope everything was clear. If you have any doubts, any queries, any questions, then you can ask me regarding the BRBL paper or from any topic that we discussed today regarding the course, anything. Thank you, Irfan. Thank you. Please, everyone who has joined on the YouTube platform, make sure that you like the video. You will get the PDF. Simply, you can visit the Oliveboard app you can download. You can go to the website. There also you will have the access to the PDF of the class that you can download. How the PDF will be shared? Once the class is over, I will upload the PDF, right? And under it, you will get the option to download the PDF. On your app only, you will get it. All right? Okay. Anything else? Any other questions if you have, then you can ask. All right, so let us end the session now. Thank you so much for attending. I hope everything was clear. You can also leave a feedback for me in the feedback option that would be given on the top right hand side of your screen. It would be very helpful for me to understand. And if you want me to make any change, you want me to increase or decrease my speed, include anything else, you can let me know. All right. Thank you. Thank you so much. Good night. Take care. All the best. And I will see you in the next session, in the next live class. Make sure that you attend all the live classes on a daily basis. Try to do that. If you miss any live class, then whenever you get time, as soon as possible, watch the recorded video. Do not create a backlog for yourself. You'll get access to the mock test, you'll get access to the PDF. You can read them, revise them, practice the mock test. If you come across any questions, any doubt, you can ask me in the live class. So that is all for today. Thank you so much. Do give me a feedback. Good night and take care. Thank you.